Hey, greetings. This is Samantha LaDuc, founder of TradeOutLoud and thank you very much for the invite, Anka and David, to the Synergy Conference. I like these gigs. This is kind of forcing me to put together lots of kind of thematic analysis for you. It's a little bit different than I think what you might be expecting if you're more of a new trader or new to me. I am a macro to micro analyst, educator, and trader. So I have a little bit different approach when I am looking at markets. And hopefully that adds some value because I'm not just focused on technicals or macro or intermarket or quant or sentiment, or even fundamentals. I like to blend them all. So that's basically why I thought today might be a really good time to revisit a theme that I have been focused on of when is it safe to buy tech. So first, a little bit about my business, and then we'll go into some nitty gritty. And I have a lot of charts and analysis I want to kind of go over for you. So I've decided I would cut to the chase at the very beginning of the presentation and tell you my conclusion. And then I will go in and dig into the details for those who like that type of analysis. All right, so first a little bit about my company. I founded LaDucTrading.com, and since then I have grown it to 8 contributors. I have a product that I run called Fishing Club, and it includes a live trading room. It includes a very detailed Slack client workspace where myself and 8 other contributors reside and post our stuff. So it doesn't really look like that on this old website. So apologies in advance. This will be fixed, but for the beginning of the next year. But suffice it to say that it's a lot bigger than this website showcases. I'm the lead analyst, obviously, and that's my product. I have a macro advisor by the name of Craig Shapiro, who was a former client for years, hedge fund manager, and now our resident macro advisor for both institutional and retail clients. So he's very much focused on the macro. I'm more of a macro tourist. In other words, this is my interpretation that allows me to come up with these market timing calls, trend, swing, and chase time frame. In addition, I also have a community called Discord, Treasure Hunters Discord server, which is more focused on newer, younger traders that have really entered the space in the past few years, right? COVID was a boon to trader education, and they needed some mentorship from professionals that basically kind of were more experienced in navigating the twists and turns. So this is definitely for those type of momentum traders, very short duration traders. It's a totally different community than my fishing club. And like I said, different also from the service that Craig provides, which is concierge macro analyst consulting and bespoke research for clients. So we have really beginning, intermediate, and advanced for not only audience, but also products to fit that audience. And because this is, I'm doing these rarely, if truth be told, because one, they're a lot of work, but also I'm not quite sure who is interested in hearing this macro to micro take. So I kind of put it out there so you get to know who I am. And this is the promotional that James, my director of marketing, is offering for those who have gifted us with your time. Right, that matters to me. This is for 3 months. You're welcome to come in, catch myself and my entire team, again, 8 contributors who are offering full-time analysis, trade support for clients, the whole bit. So this is across the entire team. It's basically a 3-month special. I invite you to kind of check that out. And obviously this is the Slack workspace, then you can take a look and see if this is of interest to you. And if it is, this is a great discount, so enjoy. All right, so on to a little bit more of this background of mine, which is discretionary trading. So I'm not a hedge fund. That's Craig's domain. My focus is very much anticipating durable trends and then identifying kind of like the counter trend bounces or swings, as well as those high momentum, volatility inspired chases. So I actually assess all asset classes, all interest rates, doesn't matter, global equities, every sector, domestically, and give levels, right? So this is what I do live for clients in a trading room, including custom engagement for stocks of interest to them. And then we support them actively if they need help, setting up an advanced option tactic to take advantage of an earnings play or what have you. So the contributors that I have really range from futures to just a commodities trader, really just excels in that and focuses on that. An oil trader, Bob's been trading oil, and before that his father. To advanced options, momentum, the whole thing. So this is a trading desk, long story short. So my background is bringing that macro and then confirming it with intermarket, test, use technical analysis, and then deliver those actionable trade ideas and setups. So those are the products that I have just mentioned to you that we also provide. So let's get right into the presentation, because I think that's going to be really, it's going to take some time to get through, and I want to be able to allow some opportunity for questions at the end. By the way, this is what I deem chase, swing, and trend timeframes. What I'm talking about right now is very much trend and swing duration. So just to kind of give you that perspective, let's do this. Hold on. Where is that puppy? Here it is. All right, so let's start here. Back at the beginning of the year. All right, I did an article and an interview and a whole bunch of other things that basically came out with my 2022 top prediction, which was we would continue to have this growth to value rotation. So I had been on this early, which is to say back in summer of 2020, I said in August, bonds were done going up, which is the inverse, rates are done going down. So that obviously has come to fruition in a big way. And once we got through the 2020, QE buzz, we actually went in large part sideways, and some big kind of sold to you distribution during 2021. And then in 2022, we started to roll over. Very, very typical, by the way, for bonds to lead equities. So again, bonds topped out in that beginning of August, summer of 2020, and then basically rolled over under the surface in 21, and then you saw it in price in 2022. And I had been basically stuck on some themes that we were going to be rotating into this value away from growth, things over paper, inflation is sticky, deflation of wages ended with COVID, oil as an inflation hedge. So all this stuff is, a year or two old, and nothing has changed. Nothing has changed. So I want to just kind of preface this a position that I had, very much so, and it still frames all of what I am going to present to you today. Okay, so if you're interested in that article or those interviews, and you're going to see some updated charts, that's what I'm going to be basically going over with you. It's kind of like an update, right? A year later. So this was my main thesis, which was that the Fed put has moved, and since 2013, I would wager it sits about 20% below current market prices. When I gave this market call, we literally were at 4,800, so 3,800 was my SPX price target. Clearly, we hit that. We've chopped about, right? We've gone down to 35.88. We've gone as high as what was it? Roughly 4,300. So we've been in a really big range, violent range for the most part this year. But the long and the short of it is that I was convinced that an accommodative Fed reduces volatility, which is what we had prior, and then a tightening Fed by definition triggers it or triggers volatility. And we absolutely have had that this year, right? In both directions. very wide moves intraday and week to week, very a la 2008, 2000. So value for me was going to be lose less than growth or straight out outperform. And as you know, we have had some phenomenal outperformance in non-tech areas. In fact, here you go, just as a case in point, in the 2 years since I posted that theme of things over paper, this is what's happened with the energy space, right? 236 roughly % relative to the rest of the other sectors in SPY. And all of my trend plays, by the way, I have a trend space for clients, is absolutely about energy and cyclical strength. And basically you can see it even in Exxon, right? It's up 214%. CRM is down 41% since that August 2020. So outperformance is the theme, okay? And now where are we today? This is basically my point. When is it safe? Because everyone is very excited about the recent bounces that we've had of size. When is it safe to buy tech again? All right, so I wrote this post, as I mentioned to you in January, about my theme for 2022, but I also wrote another one, timing tops and bottoms, are we at one now? And the funny thing is, this particular post on January 30th was, I mean, everyone was so excited about buying the dip. Now think about that right now. It's November 2020. This was January 2020. We had a big rollover in NASDAQ, and everyone was so excited about buying the dip because we were going to go up to 5,000, 6,000. Remember that? Yeah, no. So my literal point was, we had a lot of growth sectors top back in February 2021, and they need a lot of time to bottom now. Yes, eager buyers may show up to buy what's on sale, but they aren't picking a bottom. They are trying to make it. Let them. So fast forward, we continue to drop in February and into March. Then we had a short covering rally post options expiration, the quarter end, the month end, and it was of size. And then we rolled right back over, took out the lows right into May, digested quite a bit, took out the May, went into June, digested quite a bit. And then July 15th, we had a very, very strong short covering rally into August 16th. And then we rolled over, we took out the June lows, get my point? So let them, just let them make the bottom, because we're not there yet. All right, so that's still my baseline bet. Okay, and here are some examples. And by the way, this is not something that is new to my clients. So I put literally in December, in November I warned, but in December I'm like, I am worried about tech. And I went on to talk about the prediction and, you know, talk about the particular levels. And then I went on with client posting to say, okay, these just look like they are fabulous shorts, right? And we followed up with so many of these over time. And now you kind of see this, right? You got this massive drawdown from Peloton and the, you know, buy now, pay later, and DocuSign and Snap. And I could also go over the mega cap tech plays of Amazon and Netflix and Google and Microsoft and the rest, right? So the point is that still was a very good call. And these stocks are still in the process of trying to base, right? This is, you know, of basically folks trying to come in and buy them because they're cheap and they keep losing fingers and toes. So this is a long time frame for these stocks. And I said it in that January article, literally. I also warned then that NASDAQ underperformance will need 1 to 2 years to stop falling and form a base before turning higher. So it's not the same thing as chasing. We're going to talk about that. We just had a recent short covering rally for the record books, but I'm talking about finding a durable bottom that is safe to put in your, you know, IRA or 401 or however you do your long-term plays. Otherwise, they are swing longs in a counter trend rally. That's it. So I do not believe, for example, we have reached capitulation, even if Amazon, for example, has destroyed almost all of its outperformance over the past 5 years, because this takes a while before it bases. And at the beginning of the year, I showed one particular chart that I want to kind of go over right now, which is which was basically a growth to value ratio chart. My intermarket analysis is based on a lot of different things. It's correlation and it's divergences between different correlated assets. And I can find a lot of outliers that revert, right? And that's what I'm really looking for, is that divergence, and that correlation and ratio analysis is one way for me to see strength and weaknesses. So back in September, we had this spike high. By the way, that is right when I said August of 2020 that bonds would stop going up. Okay. No, then fast forward a year, we had another spike high. This is again in this ratio of growth versus value. And I have a little indicator here that I've cherry picked to kind of time the rollovers. But this has been very, very helpful, obviously, this pattern recognition sense that I have that I share with clients. So we definitely rolled over. We definitely rolled over in November of 2021 when we had outperformance of energy, right? Remember, crude oil went from $65 to $130 between December 3rd of 2021 and March 8th of 2021. All right, so that was also a market timing call, and I've gone over that with this conference before. But the point is, we are right, as you can see, from January 10th, we see the second rollover. Now, where are we now? My warning at the beginning of the year, when I showed this, we danced up the mountain, we would continue to dance down the mountain, right? And now, let me show you this. Next wave lower in tech. Check it out. So we did our damage from literally November was when it actually triggered. When I alerted clients, we had an outlier on November 9th, but it didn't confirm until the 16th of November. NASDAQ didn't actually roll over in price strongly, as you know, with SPY until the first of the year. But the point is, this was already intonating we were going to roll over. This confirmed. And then we had a strong rally. Fast forward to July through August, and now it's rolling over again. So I know folks are extremely excited about the short covering rally that's in play right now. We're going to talk about that. The fact that market has been, chopping higher, especially after the October low and the Bank of Japan intervention on October 21st. I contend this growth rollover is not done. And this is one of the charts that I have used to get and stay in this theme. So my concern, and this is the conclusion first before I dig into a whole bunch of other analysis, okay, in case you got to go. This next wave lower in tech could be like the one in 2000, when finally, after all the speculative tech blew up in early 1999, 2000, the generals like Cisco finally succumbed to forced selling, taking everything lower. So who are the generals now? You know them, Apple and Tesla, right? Because all the others have been shot. And they still could go lower. But the point is, we're being held up by Apple and Tesla. And once they start selling Apple and Tesla, why buy anything else? We'll get to a 2000 chart in a little bit. But for right now, this is, I also have another chart with a multi-decade chart of that's going to show you how intense this bear market is and how it compares to 2000 and 2008. But you got to stick around for the rest of the show. All right, so this is going to show you also, though, that what happened was a significant drop from that 2000 when the generals started falling. And of course, this time could be different, but we're still at a 40-year, it's just a very sticky inflation, right? An aggressive Fed hiking regime and an energy crisis, so it's still not safe. All right, let's talk about that short covering squeeze that's getting so many folks excited. It started actually on October 13th, but it didn't have follow through until October 12th. And I had definitely talked about this in earnest with clients live, which was kind of cool. I have a live trading room, so I could see the yen intervention that was spiking Friday morning, October 21st. Basically, the Bank of Japan, at the same time there was a US dollar swap of size, spent 5 to 6 trillion in yen to support their bond market, and that pulled down the USD JPY. And the result was the US dollar pulled back, and with it US yields. which gave the green light for risk on rally. And we have strongly moved higher since. Then we had CPI, which was dramatic in that it really wasn't dramatic, but that the reaction was dramatic. And here's what I mean. So fast forward on Friday, November 11th, I wrote this for clients. Okay, that's a short covering squeeze for the record books. Did China reopen? No. Did Russia withdraw from Ukraine? No. Did a periodic adjustment to healthcare cost segment pull down CPI, triggering a bull stampede? Yes. So the headline data wasn't that stunning. What was the gain, 5.5% for the S&P. On Thursday was the biggest in 2002, also in the biggest in 2.5 years. The NASDAQ composite rallied 7.4% in one day. It was a big deal. It was a big short covering rally. And that's why I thought this topic might be a good one. When is it safe to buy tech again? Because a lot of folks are very excited about bullish markets when you have this type of outperformance, it seemingly. Now, let's just take a look at how does it compare. It was a 4 sigma event, which has only happened about 11 times in the last 10 years. The largest 10-year treasury move, by the way, because yields dumped, right? US yields dumped, as did the dollar. And that, by the way, was the biggest move since the March 2009 QE. We're talking the bottom of the great financial crisis. That's how big that move was on Thursday in treasury yields. Non-profitable tech had the biggest up move ever. We're talking the junk, right? Whether meme stocks or the Carvanas or, it doesn't matter. Non-profitable tech, it's a big, long list. I showed it at the beginning, right? It had its biggest move up ever. That's short covering. That's not, I got to get in there and buy a new trend. No, that shorts had to cover. Financial conditions index was the 3rd largest on record. So these are just some of the data points that I pulled off. But my favorite one was from Tier 1 Alpha. They said yesterday was the worst daily mispricing of the one-day straddle in history by a wide margin. So in other words, the best play really going into CPI, because we have no edge, it's like an earnings play, is it going to be bullish or bearish, was to buy a strangle or a straddle. The beat basically of only 0.2% that has actually accelerated month over month for the past few months, managed to behave in a manner that exceeds the actual emergency rate cut in January 2001. So market was just a little crazy, wasn't it? That move was given back over the next 2 days, by the way, in 2001. But the point is, this is not 2001. We have short-dated options that are ruling the roost. So these 0 destination till empty, I call them, but they're really days to expiry. They are driving an enormous amount of gamma flow into the indices and single stock options. And they are absolutely what's dominating the call volume out. And this is what's making stuff move. So they all kind of contributed to this risk of very small changes in demand or supply, or just seeing historically large price moves in both directions. And it is oh so 2000-esque. Again, wait for that big chart that I'm going to show you toward the end. That will really cement this reference. Anyway, I keep saying that this price behavior is more in keeping with the volatile euphoric melt up from 2000 and 2008, just before the brunt of the fall. So far, we've had controlled downside for the most part, and they have been softened by US dollar swaps and VIX suppression and timely Bank of Japan interventions. If these are all macro themes that are a little hard to understand, 1, become a client, 2, follow me on Twitter. They're absolutely critical for understanding market structure and direction. But no question that this in the short term has helped alleviate some recent global bond crises, like the one that happened at Bank of England, right? And has triggered pension, and that had obviously triggered pension stress, and not to mention sovereign credit crisis fears. So all of that aside, that intervention right before we were about ready to crash lower in stocks and bonds, and I literally called out a warning on the Thursday before, because my indicators said, if bulls don't defend here, we're going to crash lower. And literally the next morning was the Bank of Japan intervention. it was a freak. I swear to God, they heard me. Anyway, it was hysterical. But my whole point is this is intervention. We've had a nice rally. We could go another 100 points or so, but just keep in mind, the biggest one-day gains in the stock market history have come in bear markets, not bull markets. So I am still of the opinion that NASDAQ underperformance is still the play, whether it be my article and my interviews from January 2022 to today. I still believe that we are hovering around this 3,800, although it's violent, right? We still have room. Risk is to the downside, maybe not this year, but moving forward. And I want to kind of lay out why I think that. Okay, so first and foremost, I do this intermarket analysis I mentioned a few times. And yes, we had this big, tech basket go crazy. It's best two-day jump in history. That was that Thursday, Friday. We got some market structure that's definitely coming into play. Short covering for sure. That's, Goldman talks about that a lot. Quant gurus are talking about that a lot. Gamma, all of that optionality within the market structure is something that changes, just like the Fed balance sheet, right? The runoff, or the treasury repo rate, all of that stuff is about liquidity and it's about positioning. And, that's one thing that I like to do, but for me, it's patterns. And I can see patterns pretty, let's just say better. If I can see a pattern, I am very interested in it. For example, this was the pattern that I spied. Okay, I don't know if you can see this image, but this was the pattern that I spied back in that January when I did that presentation. This is NASDAQ to SPX. It's a ratio chart. That was a 2000 high. And so I said, this looks like a head and shoulder, right? This looks like a head and shoulder, and it looks like it should come back down here. Well, it did come here, and then it bounced a little bit, and then it broke, and now we're bouncing again. So let me show you. This is what I literally just showed to clients recently, 11/8, right before that record-breaking short covering rally. This is what it looks like now. So we tagged that monthly support line. Oh, I should also let you know these are big trends. So this is on a monthly. So not only did that follow through, right, that head and shoulder, which was my supporting evidence for NASDAQ underperformance, check, that worked. But we also came all the way down to this channel from 2009. We bounced, by the way, that was July, August. This little bleep is only March, but this is July, August, and it actually was a little bit bigger. And then it crashed through, and then it hit this line, and then it bounced. So right now, you can't see that because it's on a monthly. So I have to show you, this is when I grabbed it, bounce or trounce, send it to clients, and then obviously we bounced. But here's the problem, right? We're going to retest that. And the question that you need to have is, what if it doesn't hold? Or what if it takes months or years within this kind of wedge to figure it out? No, you need to know what you own, right? So I like to combine that first chart that I showed you with this chart, just to kind of show you the roadmap. For me, is we still have risk of more growth weakness, even though we've had a massive rally this week. That's all it is. We still have risk to the downside. And big picture, this intermarket tell helps me stay in the right side of the trend. All right, so do mega cap tech matter? Because this is obviously a big component or weighting in SPY and NASDAQ. Well, they do, right? Not only does the Fangman market cap as a percent of S&P represent a lot of wealth destruction, but they also represent pretty much holdings in every passive index fund, mutual fund, major portfolio, and even some national banks. Swiss National Bank is one of the largest holders, for example, of Apple, etc. Their top 10 assets are largely tech. So you've got this selling that is happening in Fangman stocks, By the way, S&B has lost $167 billion as of the third quarter. So this is all represented as a big problem. Stocks went down, bonds went down. Now there's this underperformance. So if you see a 2-day short covering rally that gets followed through, you've got a lot of funds that are underperforming this year, and they are desperate to play catch up in some way. So to me, this is still not done. Fang Man, whatever, New York Fang, which you can also chart, continues to falter and still has room to fall. Even tagging the 2018 highs is not out of, reasonableness. We're still, as far as I'm concerned, getting out of bubble valuations. We haven't even priced in recession risk. So speaking of recession risk, I got to talk about the macro. So I've shown you, how I got here, right? I've been very consistent in this call. Nothing has changed. I've shown you the intermarket, which has absolutely guided a lot of my analysis for clients and help them navigate trends, swing, and chase timeframes. Let's talk about macro. So the macro matters to market returns, especially tech, because we are all rates traders now. When we had a, basically zero rate regime, there was a lot of funny money printed, and there was a lot of wastefulness and speculative assets in the crypto space in particular, but not just, right? A lot of non-profitable tech, a lot of venture capital, just lots and lots of checks were written. No problem. Lots and lots of money sloshing around. So now, if we are all rates traders, then we have to care about yields, what the Fed does with those yields, and we have to care about the dollar, because this is emerging market pressure as the dollar goes up. It's also corporate margin contraction, compaction, for lack of a better word, because it's a hit, right? As the dollar goes up and they're selling products outside, and they need to take a currency hit. But mostly it is definitely an FX risk as it relates to global market equities and growth, economic growth. So I still don't believe we've seen a cyclical top in the dollar, even though it has come back about 5%, roughly $114.75, and the Dixie is kind of moving down to 105. So it's taken a $10 haircut roughly. I think it's going to get supported above 104, but that's not the most important part. I'm just saying I don't think the dollar is done going up. I'm pretty convicted in that call that the dollar is going to go up, and so will yields. But right now they've pulled back very aggressively to allow this risk on rally. But in order to have this, continued bullish bent, tech bulls have to really get excited about growth opportunities, because these are momentum. Tech is a play on exponential growth or growth of any kind. So if we have a pullback in growth in the economy and in GDP, that's going to obviously hit tech. So as far as I'm concerned, I just don't think the Fed's going to pause, which is stop hiking, or pivot, cut rates anytime soon. Lots and lots of debate on that. I'm very consistent, and so is Craig. We both don't agree that the market is pricing in this reality of higher for longer. That aside, let's take a look at the numbers, okay? GDP, what's the growth prospect for the US? Just so happens that this week, Bloomberg released their November survey of economists for global growth over the next 3 years, and summarized really well. They have a cumulative downgrade through 2024. So in the February survey, right, enough time has passed, the expectation for global GDP growth over that period, 22-24, was about 11.4%. That's over 3 years. Remember, this was the beginning of the year for 22, 23, 24. It was 11.4% over the next 3 years. Today, that number has been lowered to 8%. Very likely it gets lowered even more, just like earnings have come down, right? Earnings peaked in June, and now the estimates for the last earnings went from 10% to 2.2%. They're still pretty high for 2023, but they're being pulled down. We'll talk about that a little bit later on. But the point is, this is very much a hit to the growth prospects, right? We also have, things are just not, big picture, stronger, marginally better in the short term since the October low in markets, but also with the CPI and PPI weakness, but horrifically worse in the long term. So let me kind of show you some of these weakening indicators. First, inflation. Yes, we had weakening CPI, consumer price index. That is this little line right here of yellow. Okay, and PPI was yesterday, but the point is we had a knee-jerk reaction to the dollar and yields getting pulled back. But services PPI is this white line. Services PPI in large part is more important than the goods PPI. It constitutes rising wages. And I did an article in October of 2021 about the deflation of wages ended with COVID. And that was going to be the enemy of bonds. And sure enough, it was absolutely the call. So we have higher wages contributing to higher services CPI, which is going to make inflation sticky. Okay, so this is basically it. Also, once inflation gets above 8%, which we have had, right? We had a steady few months back in 2021 of 5%. And then it was getting higher and higher and higher at 9.2, and it has come back down a little bit. But the point is, median inflation takes about 2 years to even fall beneath 6% before settling around that level out to 5 years, right? This is a big deal. This is not going to come down and be done. We can come down quickly, and then we enter a recession. That's one baseline bet. We can come down and then go right back up. Maybe oil spikes higher. Right? Wages stay more than sticky. The point is, this is a marathon, not a sprint. So Fed Waller was out recently and also reiterates 7.7% CPI inflation is enormous. It's really not so much about the pace anymore. It's where we're going to end up. And where we end up is going to be driven solely by what happens with inflation, right? So inflation is staying sticky. Oil is still in an inflation hedge. Things over paper meaning tech, value over growth. In other words, the point is that this is going to stick around. Even US core inflation, even if it was to half its monthly pace between now and the next 8 or 9 months, we're still going to sit at a high year-over-year core inflation area. So the hurdle for the Fed to pivot is really, really high. So all of this short covering on China reopening, I don't buy it. Fed pause or pivot, I don't buy it, because the numbers, the math just doesn't add up. Okay, so long story short, there's a way to go. There is, in my opinion, a ways to go before rate hikes are done. And even if they step down the amount, right? So right now they're already talking about 50 basis points in December and then 25. Well, how many 25 basis point hikes are we going to get for how many years? It's higher for longer, even if they do a step down. So direction is more clear than duration, but in no way do I believe that the Fed is going to pause or cut or pivot on rate hikes. And this is basically the enemy of tech. So I just think the market structure has short covering written all over it, not bear market bottom. So things still, I keep reiterating, might have gotten better in the short term, but they have gotten worse in the long term. Let's talk about recession. I'm going to talk about a few things real quick, and then we'll get to some major charts that I really like. This is just a data point regarding real inflation adjusted weekly wages. Okay, wages matter. And we can see from this that they have declined over a year-over-year basis. It's always taken place when that happens, a few months before a recession. And got this chart, also kind of credit where credit is due. Here it is. David Cervantes of Pinebrook Cap. This indicator has 100% batting average over the past 60 years. Okay, so we have not come back down through this zero line, but that would be a very strong indicator of recession risk. I got another one. Unemployment is definitely damaging to housing and vice versa. Mortgage rates have doubled, right? Housing has already entered a recession by all accounts, not the economy. Only housing economy has entered the recession. But it's important to also keep in mind that construction right now is still playing catch up. There's a lot of backlogs. So they're still employing folks. Once they catch up, then they let folks go. Idaho, largest employer of construction, just let their staff, 50% of their staff go, but that's not the national average yet. So once they start to impact the unemployment rate, which they will, because they make up 15% of GDP, and that drives the business cycle, you'll see this line, which is employment under construction and new houses for sale. Once this kind of dips below this zero, I should say, sorry, the red goes up, sorry, is unemployment, and this blue line goes down, which is houses for sale by stage of under construction. That's another really, really strong indicator of recession, right? So that was 2000, that's 2008. So the point is, we still haven't gotten there, but we're getting closer. Recession watch. Craig did a great article in Investor Place. If you take a look at this, if you want a really good read on has inflation peaked, what the CPI means for the stock market. He's got a few articles in there, but that, oops, hold on. Just lost my, okay. No, that's not it either. Hold on, I just lost completely my page. Funky. I gotta find it now. Preview, there it is. All right. I'll go back. It's down here somewhere. Go, 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 go. All right, so then, forgive that intermission. Let's earnings matter. Definitely. This is really important as it relates to the Fed path, by the way, of hiking into higher unemployment so that we can get lower inflation. That will have an impact on earnings and obviously tech as well. And I don't believe that this has really even been priced in yet, if truth be told. So we couldn't, I think, identify when this is going to happen, because typically it happens slowly, then all at once. But again, less inflation right now, since CPI means lower rates in the minds of the market participants, and lower rates usually mean higher stock prices, so they've chased it up. But what about earnings? So there is evidence that this current wave of inflation peaked in June. Well, there's also very strong evidence that so did corporate earnings, and this is not bullish. So right now, the divergence between earnings and sales expectations have clearly signaled shrinking margins ahead. Okay, that's from the Daily Shot. This is my graph, and it's a really good representation of the trend reversal. It's a pullback. Let me just show you. This is gap SPX on a monthly, and it's over decades, right? And this has been for those who are really more portfolio focused and trend focused, but it's great because you want to swim in the direction of the current, not against it. So this is the great financial crisis, right? And it popped up strong QE. This is the COVID crisis, and we popped up strong QE. We're starting to roll over. We've just started to signal a rollover. And I contend that the pullback in this gap SPX, which is SPY earnings in gap terms anyway, will come right back down to test the top of this trend line. And how it handles that pullback is going to determine whether this is a soft landing or a hard landing. And this is a chart that I regularly update for clients because it does matter, but it's really only once we get to earnings. And then here we go, zoom out. We have moved from, valuation correction to earnings decline and have yet to experience a recession. This is a chart that kind of shows that same thing over, a long period, many decades, that we have yet to even experience. Look at this, you can't even see it. Like, this is earnings, the S&P 500 EPS, and when we've had recession, okay? When we've had recession is when earnings rolls over. We haven't even rolled over yet in earnest. So this is the chart I wanted to kind of show, and then maybe answer some questions. But again, I still have this feel that there's still danger ahead, right? So otherwise I would say, hey, this is a great bottom, go get it. But I don't. So here's case in point, and this is the chart I really wanted to kind of highlight for folks. This is my thing. I study rate of change. Okay, this is the NASDAQ. We know about the NASDAQ bubble back in 2000, right? And then when it finally fell, by the way, let me find that chart with the annotated dates. Hold on. I sent this for clients, but I want to show you the actual yeah, this is better. Okay, so take a look at this. So here's a 2000. Okay, we crashed from 2000, then we rolled over, by the way, right? I had mentioned that. So October 2000, and it took how many years? Like 2.5 before we finally got up June 2003 and had a bullish, quote unquote, tech is safe. Fast forward to 2008, we started rolling over, you know that, in October 2000. And this just really picked up speed to the downside. Yes, we had March QE intervention, but when was it really even out back in play, quote unquote, to be safe tech? September of 2009. Here we are. Here's the the February 2021 high. Remember, I really like divergences. So I was able to spy when the K-Web collapsed, the Chinese ADRs, because they had a weekly gap down, that kind of thing. SPACs, did a whole bunch of interviews, actually 2, really strongly. SPACs were dead. It rolled over. The point is, this rate of change spiked and then rolled over, but it wasn't until April of 2022, not February of 2021, when underneath the surface stuff started breaking. And then this year we started rolling over. But April of 2022, when this indicator signified we're in a really bad bear market for NASDAQ. So, 35%, we had a drawdown here in COVID, but we didn't break below. 35%, we had a drawdown in 2022 in NASDAQ, but we didn't break below until April. So this to me is a serious chart, I should say, to take it seriously. The other one is my yield chart, which I've shown clients repeatedly over the past 2 years. It basically looks inverse to this, where rate of change is up here. It's bizarre how strong it is. And that rate of change signifies a momentum thrust, bullish. So that momentum thrust has basically stayed there for a year. So no, 2. It actually triggered in 2020 in the summer, and then it stayed there. And that's a multi-year indicator of rates moving higher. And with that on the upside and this chart on the downside, tech is just not a safe, happy place right now. All right, so we can have some solid bounces, and obviously stock picking matters. But here's another consideration, and that's kind of the last nut to crack, is yield curve inversion as a recession tell. Recession matters, right, to returns. So markets aren't pricing in recession risk, in my opinion. They're pricing in a soft landing, and that's basically one in which earnings don't price in this Fed-induced recession. So this is a data trek chart of inflation, when inflation is falling off very quickly, and that's assuming we don't get a spike higher in oil. But for now, let's just assume that we have basically a CPI that has headline CPI that's rolling over. Every time it has in the past, it's picked up speed, and then we've had a recession, or somewhere been in the midst of a recession. So be careful what you ask for, kind of thing, right? So everyone's excited that inflation expectations are going down, and CPI, dropped, even though there's some irregularities in that particular print. The point is, will the same be true now, that as inflation peaks and starts to decline, it picks up speed, and it's actually a tell for a recession? It has happened in each of the inflation rollovers in modern history. So then we kind of come down to my favorite indicator for yield curve inversion, and that is the 30-year against the 3-month. So the shortest duration yield index against the longest, right? 30 years, the mortgage one that we're obsessed with. But the 3-month one is the one the Fed keeps fueling, right? They're going to hike, they're going to hike, they're going to hike. This thing keeps going up. And the difference is the spread. And as you can see recently, and I warned actually clients in April, remember that month again? Yeah, that's when I warned in April. And we have since crashed all the way down, October, November timeframe. So what does this mean? We were here in 2000, 2001, before we got a bear steepening. We were here in 2007 before we got, out of it in 2008. And that's when the markets actually started to falter. So you got to think about that, right? So right now, you have a Fed futures rate expecting that we're going to they're going to, I should say, keep raising until Q1 and then be done or something. That's like not my baseline bet, but that's the market seems to be pricing rate cuts in later. So that is contrary, by the way, to what Powell keeps saying, that they're going to be increasing, not reducing its expectations for Fed funds in 2023. But the markets don't believe him, clearly. But the bond markets do. So inflation is slowing is a sign the economy is edging closer to a recession. And those two charts that I just showed you, the one by DataTrack and the one that I just, showed you, the spread is cautionary, right? So we basically have the situation where the curve steepens massively, a la 2000, 2008, at the beginning of a sizable recession, because the bond market starts to believe that the Fed will need to eventually stimulate growth via cutting rates again. So we're at that inversion phase. And I warned in April, things, right now look like they've gotten marginally better in the near term in that past month, since the October low and the Bank of Japan intervention, with inflation expectations dropping, with equities, rallying, with bonds bouncing up off the bottom. But guess what? They are threatening to get a lot worse in the long term. So is tech safe with these conditions? So granted, we've only earned inverted right now. And at some point, I think we're going to have a steepening, when the 3-month yield starts to fall and the 30-year doesn't fall as much. But the point of the matter is that this is a headwind for housing, for consumer balance sheets, obviously for growth stock multiples. We're not just talking about valuation, but we're also talking about profit and margin compression for corporations. So all of this still is a headwind. So my last thing before I close is, will a Fed pivot fix this? Okay, my answer. It's going to be no. That's a no is a complete sentence. But let me just show you another kind of funky intermarket chart that basically says the Fed is already overshot, Fed is trapped, there is no Fed pause or pivot coming unless the markets crash. So this is funky, but just bear with me. I use TradingView. I got a 5-year and our debt structure and the federal funds rate. And basically I'm putting this together into a formula that shows when the rate hiking cycle has ended and then what has happened. And this happened in 95, again in 2000, again in 2006, right before markets actually fell in 2008. But the point is, we did it again January 2019. I don't remember anyone remembers the repo after the 2018 20% quick drawdown. Manchin had to call the banks, and then we had still some sputtering in the bond market, and then we got this repo solution, and then we had COVID, right? And so this is the call here in August of 2020. Bonds are done going up. You got to remember this is on a monthly time frame. Point is, the Fed has already raised rates so aggressively that we've broken through this trend line, monthly trend line of major support. And we're now just in this never land where the Fed is trapped. They're going to keep raising, and then they're going to try and pivot. Markets will get all excited, then they're going to raise, they're going to pivot, whatever. The point is, this is not a place of safety for equities or for the economy. And then watch out for oil, because if the Fed telegraphs any type of pause or pivot, my bet is that oil will shoot higher, and this will force the Fed to revert once again. So I had made a call in March of 2021 that if crude had stayed above 65, it would double to 130 by the following year. It happened. And then we had a massive amount of intervention over the summer with SPR releases into midterm elections. And now they've created this oil, I think, backdrop that is forcing this supply constraint crisis. So I kind of make it akin to, I know I'm getting off track a little bit, but I think oil is going to be the absolute Achilles heel of the Fed. So I'm going to go off track for 1 minute. Just hear me out. So we already had, demand destruction for all kinds of reasons. China shut down, war in Europe, and weakness, economic weakness that's forthcoming. But the biggest issue is supply as well. And the fact that government intervention has kept that down and suppressed volatility as well as oil price. And the point is that after a while, we know that the energy policies have prevented this oil from kind of having a natural price discovery market, and there isn't a lot of open interest in oil because why? They're forcing ESG initiatives, so there's not really an investment mindset for oil and gas. Long story short, this is when it becomes more of a chronic illness. So if policies are going to continue to suppress oil supply, then this is going to become a bigger problem later. Kind of like if you get sick, right? First of all, you want to prevent getting sick, but then if you do get sick, you want to be really early with identifying and treating it. But then after a while, if you just let it go, it becomes chronic illness, and it's a really long, hard path to get back to health. That's our energy policy right now. So I think that's going to rear its head again in the coming year, and price of oil is going to go much, much higher. But for right now, the Fed is trapped. And the last thing I want to kind of show you is be careful what you ask for, because a lot of folks right now are excited about a Fed pause or pivot because we have low, unemployment, and that's Goldilocks. But the Fed wants to turn that upside down. They want inflation not at 8%. They want unemployment at 8%. They don't want, this unemployment at 3%. So they want to turn this, they need to lower wages, which is terribly impactful on middle, lower class. It's just, unfortunately, that's what they're trying to do. So they want unemployment to go up in order for inflation to go down. They want to turn those in numbers and reverse them. So this is when we get around to a proper Fed pivot, which is a rate cut, not just a pause. This is what has traditionally happened. Market falls even more. So there's a rule of thumb, and my last line of warning is that we haven't even pivoted yet, right? Speculation, but not actual. What happens when we pivot? Market falls more because they really now know that the economy is in trouble. So don't buy the first pivot, buy the last one. And then you can buy tech again. All right. Hope that was a little helpful, at least to see my thinking of how I approach this. Chase, swing, or trend time frame, these are all tradable setups, there's no question. But I also like to kind of, like I said, swim with the current, not against it. And the current is higher rates, likely higher dollar, and that will trigger higher oil in time. We have a fabulous promotional, if you're interested, coming in for 3 months. You get a discount, a great discount that gives you access to not just myself, live trading room, and all my analysis, macro, intermarket, my market thoughts, all that trade setup, custom engagement, but you also have 8 contributors. So I highly recommend checking this out. Thank you, David and Anka, for this invitation. Hopefully I explained a little bit of how I come to this call of NASDAQ underperformance is not done. It's not safe. And I'm happy to answer any questions. I'm going to probably load this when David is done on my YouTube channel as a feature presentation. And then you'll be able to have some access to this. If you're a client, you're going to see this in your market thoughts. As soon as this video is up, I'll also send you the write-up. As you know, I mentioned I was going to be doing that for clients as well, so they can see it all in one place, but they've got it all. They've got it all. This isn't new for them. They're just, I will let it, be posted as well.